Thank you very much, Baz, for that introduction. I wish my parents had been here. My father would have been proud and my mother would have believed you. I'd like to thank the Energy Centre for the invitation. This is my first trip to New Zealand, and after 4 days I'm determined it's not going to be my last trip. So it's been a very good opportunity to come and tick one of the things off my bucket list, which was a sort of visit to New Zealand, although to do it in 6 days is hardly doing it justice. The topic I want to talk about, despite the rather enigmatic title, which I promise I will explain, is I really want to talk about the prospects for oil prices. And in the process of this, I'm afraid I'm going to have to turn you all into economists. It won't hurt very much. Some of you may feel a little indecisive for a few days afterwards, but that will eventually pass. Let me just talk about the outline, what I want to do. I want to start by talking a bit about the context and talk about the prospects for oil demand and the prospects for supply. I then want to have a little bit of a look at history, and in particular look at the changes to the global oil market since the 1970s. And the logic for looking at the history comes from a famous quote by Otto von Bismarck, who once said, "Only a fool learns from his mistakes. I learn from other people's mistakes." And so if you look at what went on in the past, you might have a chance of not repeating the same sorts of errors. I then want to introduce you to something that I've been calling Opex Dilemma, which sets the scene for the future level of prices. And the conclusion I come to, and I'll give you the conclusion straight away, is the oil market is in for a period of extreme price volatility over the next 5, 10 or 15 years. And so I want to finish off, and this is the bit that is rather presumptuous of me, having been here for all of 4 days. I want to look a little bit at what the implications of this might be for New Zealand, in the hope, if nothing else, of starting a bit of a discussion afterwards in terms of the Q&A session. So let me start then with the prospects for oil demand. This is estimates from a number of sources, including the International Energy Agency. The MPC is their new policy scenario. The CPC is the current policy scenario. The Energy Information Administration of the United States. Sorry, I'm doing the wrong thing here. And BP. And it's basically looking at the prospects for growth of energy consumption from 2010 to 2030. And as you can see, in terms of total energy, the bulk of the increase in energy demand is going to be coming from the non-OECD countries, what BP calls the emerging market economies, which is what we used to call the developing world, but also the transition economies as well. And as you can see, in terms of total energy, there is going to be an increase in oil demand. I don't think anybody is going to dispute that. However, having said that, let's look at a little closer at the IEA's estimates. Now, as I say, this comes from the IEA's new policy scenario, and it shows the increase in oil demand from 2011 up to 2020 and 2035. Now, what's interesting is, of course, OECD oil demand is going to fall. We have peak oil. Nothing whatever to do with the peak oil nonsense of geologists, but peak oil because people don't want it anymore in the OECD. So all of the growth is basically coming from the non-OECD. And here, the key are the mix. You've heard of the BRICS, Brazil, Russia, India, China. Those of you following Eurozone crisis will have heard of the PIGS, Portugal, Ireland, Greece, Spain. Meet the mix. Middle East, India, China. And together, they account for 68% of the non-OECD growth in oil demand. Now, there are very few advantages to getting old, but there are 2 advantages. One is you can say, yes, I remember. I was there. I was involved in that. And the other big advantage is you collect stuff. You accumulate things. And one of the things I have accumulated is the first World Energy Outlook that was published in 1977 by the OECD, not the IEA, the OECD. And this document is a very small, thin document. Any of you know the current IEA's World Energy Outlook? It's sort of A4 and that thick. You drop it on your foot, you break your toes. This one was sort of about that size and about that thick, so it was more like a pamphlet. And in there, they projected what oil demand was going to look like in 1980 and 1985. And as you can see, the view was oil demand will go rising forever and ever and ever. The actual turnout was completely different. That is what they were projecting in 1985 in the US, Japan, and the rest of OECD. That's largely Europe. And the actual turnout was a level of oil consumption that was way below the level in 1974. And you ask yourself the question, why did they get it so wrong? What did they forget? And of course, what they forgot was prices. Now, I'm proud of a number of things in my life, one of which is teaching my cat to do a high five. One of the others is this slide, which took me over a month to actually put together. And it shows you, for 12 developing countries, now South Korea, of course, is part of OECD, but we're looking here at the 1970s, 1980s. These are 12 developing countries, and for each country, I gathered the final price of the oil product. So this is I turned it into an index. So you're looking at an index of the weighted average price of final oil products to the consumer. So we all start together at the same level in 1970. Going along, the first oil shock of 1973. Only 3 countries passed on that higher price to their consumers, and that was Korea, Argentina, and Brazil. The rest of them decided that they were going to introduce subsidies rather than pass on the higher prices. The logic, they said, well, we don't want to hurt the poor. That was dishonest nonsense because the poor weren't using oil products. They were frightened of the political reaction if they started to increase prices. Going along again, the second oil shock, 79-80, and again, this time only 2 countries, Argentina and Brazil, Korea and Brazil, passed on the higher prices to their consumers. So what? Well, the so what is in the next slide. And it's measuring the energy intensities, commercial energy intensities, in a number of countries. Here we have the OECD countries, Japan, Germany, France, UK, profligate United States with all the energy that they use. This is the amount of energy is required to produce $1 of GDP. It's not PPP basis. I'll have that argument with anybody who wants it later on, okay? Now, remember the 3 countries that passed on to their final consumers the higher prices were Brazil, Korea, and Argentina. Lo and behold, they have similar levels of energy intensity to the countries that did pass it on. The countries that didn't pass it on, the countries that kept subsidies, have very high energy intensities indeed. Now, this is a simplistic argument. There's a lot of other things going on there. But the point I'm trying to make here is that prices do matter. Prices make a difference. And the significance of the mix are 68% of the non-OECD oil demand growth is that in all cases, they've had highly subsidized prices to their final consumers. That has finished in India, or is finishing in India, starting in 2002. It's finished in China at the start of 2009. In other words, in both countries, higher prices are being passed on to their final consumers. In the Middle East, they're talking about it, but now is not a particularly good time to increase energy prices because of political problems. But nonetheless, what I'm saying here is that a lot of the conventional views of future oil demand are making the same mistake the IEA made in the 1970s. They're neglecting the price impact. So I'm suggesting that the growth in oil demand is going to be less than a lot of the conventional wisdom suggests. Now, don't get me wrong, I'm not saying that Chinese oil demand is going to disappear. Clearly it's not. It will continue to grow, but I suspect not at the sort of levels that a lot of people are expecting. So the future of oil demand basically is uncertain, is the first message I want to leave you with. What about supply? What are the prospects for oil supply? Well, this is estimates of conventional oil is red, unconventional is blue. These are estimates of proven reserves. Proven reserves are defined as oil that will be produced given current economics and technology. And as you can see, it looks like this. Now, this is a pretty useless slide. It reminds me of the story of George W. Bush being briefed by Rumsfeld on the situation in Iraq. And at the end of the briefing, he said, "Oh, by the way, Mr. President, I think I should tell you that yesterday 3 Brazilian soldiers were killed in Baghdad." And George said, "Oh, that's terrible. How many are in a Brazilian?" Million, billion, trillion, Brazilian. Okay, think about it. Large indeterminate number. So what we have here is Brazilians of barrels. It doesn't really tell you anything at all. So what we need to do is to say, well, how does that pan out in terms of how much is actually being used? And to do that, one tool is the reserve production ratio. So you take the estimate of reserves, you take the production in any year, and that gives you the life of the reserves. And as you can see, for oil, it's about 56 years. For gas, 57 years. For coal, it's over 100 years. Now, you have to be careful with this number as well. It can be a pretty useless number. If you do the arithmetic, and I've done the arithmetic, and take the result to the sort of nearest, to a lot of decimal points, you find out the oil runs out in 2065 on the 26th of January at 08:55 GMT. I'm glad you laughed because it illustrates what a stupid number it is. You can imagine the 9 o'clock news guy saying, "I've just been handed a piece of paper that says the oil's run out. I wonder how I'm going to get home." Okay, it's much more complicated than that. But the issue on the supply side really is not so much the resource base. We know that is huge. It's a question about the willingness and ability of the operators to invest in and produce that oil. And this is the key issue. Now, before the 1970s, the Seven Sisters dominated. Now, for those of you who are not familiar with the term Seven Sisters was a term, almost an abusive term, invented by a guy called Enrico Mattei in the 1950s, who was head of ENI, the Italian National Oil Company. And the Seven Sisters were 5 American companies, 1 British, 1 Anglo-British, and often CFP, Compagnie Française de Pétrole, is included to make up the majors, the sort of honorary 8th sister. Now, these companies today, the question arises, are they willing to invest and put the amount of money that is needed in a world where their financial strategy is based upon value-based management? Now, I don't want to get into the technicalities of this, but very simply explained, it says if you're a company investing in a project, if your project can't earn at least as good a return as other projects in the same sector, you should give the money back to the shareholders. And that is what the big companies have been doing in droves. And it's quite interesting because Bloomberg 2 days ago produced a report that showed that ExxonMobil, Chevron, BP, and Shell, the remaining Seven Sisters, were all announcing increases in CapEx. The only company that was announcing a cut in CapEx was Total. Guess which company saw the highest increase in its share price? It was Total. Okay, the shareholders don't want the oil companies going out. The problem is they can't get access to the low-cost reserves. That's another issue. Now, since the 1980s, the 6 brothers have dominated. Okay, this is the other bit of the title. So meet the 6 brothers. The 6 brothers are the 6 national oil companies that dominate oil production in the Gulf. Saudi Aramco, Kuwait Petroleum Corporation, Abu Dhabi National Oil Company, the Iraq National Oil Company, National Iranian Oil Company, and Qatar Petroleum. Now, what's the significance of the 6 brothers? Well, again, I'm going back to the IEA's new policy scenario. And they have said, basically, between 2010 and 2035, the world will need an increase in oil production of a little over 13 million barrels a day. Of that increase, 91.2% is coming from the 6 brothers. That's such a frightening number. I checked the arithmetic about 10 times. This raises the issue then about the willingness and the ability of the 6 brothers to convert their resources, their reserves, into barrels of oil. Not interested in barrels of oil, we're interested in barrels of gasoline or gas oil or whatever you want to think of it, into above the ground resources. The willingness concerns the depletion policy issue. 40 years and 2 weeks ago, on the 16th of October 1973, was the first oil shock. 2 weeks before that, I rocked up in Beirut to start my first job as an assistant professor of economics at the American University of Beirut. The timing was perfect because I was the only academic economist in the region outside of the oil companies who knew anything about the international oil business, because all my postgraduate work had been done on oil. So I spent a very interesting 2 or 3 years going round the capitals of the oil producers of the region, talking to the policymakers. And they used to say to me, you know, Paul, we've thought about this a lot and we've come to the conclusion that oil in the ground is worth more than money in the bank. In other words, we're going to leave it in the ground because it's going to be worth more in the future. Now, over the last few years, I go back to the Gulf a great deal. I've been going around the ministries, talking to the policymakers. Some of them are still the same policymakers that were there so many years ago, and they've got more sophisticated now. And they say, you know, Paul, oil in the ground is worth more than money in the bank if the bank has subprime mortgage assets. In other words, why produce the oil, give it to these institutions, we don't really know what the hell is going on. What about the ability of these companies? Well, the record is mixed. I've just finished a major study that was being done by Stanford University, funded actually by BP, looking at national oil companies. I commend it to you if you're interested in national oil companies. And the conclusion we came to was that in terms of the six brothers, Saudi Aramco is an excellent company. In terms of its technical engineering ability, it is first rate. ADNOC and Qatar are okay. But three of them, KPC, NIOC, and INOC, are disasters. Not the fault of the people running them, it's the fault of the political system that they're operating in. And I look at this sort of a thing here, and I think to myself, time to think about buying an electric car. So what I'm saying is, the supply side is significantly uncertain. Okay, a little bit of history. Global oil market since the 1970s. Before the 1970s, the market was dominated by the Seven Sisters, plus CFP. And these companies were all operationally vertically integrated. Economists love jargon. The reason we love jargon is because if you use a lot of it, somebody has to pay you a large sum of money to interpret the jargon. The priests and the lawyers got there before the economists, but we're trying to catch up on this. Now, all that means is an operationally vertically integrated company is the company has oil fields, refineries, marketing and distribution networks. Their oil goes from their fields to their refineries supply their products to their marketing and distribution network. Now, if you think about that, these are all inter-affiliate transactions. There ain't no price. Okay, the price is effectively the figment of some accountant's imagination as a transfer price from your oil field to your refinery to your marketing and distribution network. And the result of this was that you had to have some sort of price to determine tax, and so the industry introduced posted prices, and this was a tax reference price. Now, what this means is the oil price was effectively an administered price. And it was determined because a group of men in a room, politically incorrect but historically accurate, a group of men in a room set a number, and providing those outside the room, the refiners believed in the number, that was the oil price. It really was. It sounds ridiculous, but that was how the oil price was determined. Now, before the 1970s, the men in the room were from the Seven Sisters. And guess what? The guys outside the room, the refiners, were from the Seven Sisters. What a lovely system. Do you like the price? I like the price. Deal. Okay. And it's not for nothing that this was called the golden age of the oil industry. It gives you an idea of who writes the sort of the history of these things. Now, since 1950, what I'm saying is the companies could have had any price they wanted. They actually chose to say a relatively low number. It's interesting to ask why. Well, the answer was, first of all, they were frightened of competition from other energy sources. The thing that kept the CEOs of the Seven Sisters awake at night in the 50s and 60s was nuclear. So cheap we won't have to meter it. They felt if they pushed the price of oil too high, then the demand for oil in generation, and in the 1960s, the increase in electricity generation was fueled almost entirely by oil. The choices were oil, oil, or oil. Then if they put the price too high, this could stop that. The other thing they were frightened about is that the OECD countries were going through their so-called economic miracle, growing 8–10% per year. This was based upon cheap energy. If the companies had started to get greedy, then the US antitrust people, the British government, the French would have come down on them like a ton of bricks. So they were relatively moderate. And if you look at a history of oil prices, this is in real terms, so it's in 2012 dollars. Here's World War II. The end of World War II in 1946, as you can see, up to the early 70s, the real price of oil was falling and was quite low. Then, of course, things change. 1970, a young man in the uniform of a colonel of the Libyan army walked into a room where the oil company men were talking about what number they were going to say, and said, hang on a minute, guys, we want a say in this. This was the sort of start of the first oil crisis, and the result was that the governments and the companies sat in the same room and set a number. And in October 1973, the Arab Opec members and the Iranians, a bit of poetic license here, suddenly looked at each other and said, hey guys, we're men in a room. Why do we need the oil company people? It's our oil. We'll say a number. And on the 16th of October, they did. And that was the first oil shock. The international price of oil quadrupled with the following meeting in Tehran in December about 4 times. And you can see that here. That's the first oil shock. Then 79–80, the second oil shock. So how is the oil market different today? It's very different. The first point is the market is now dominated by the 6 brothers. They are the main players. The oil price is now a market price based upon spot prices. 50, 60, 70% of the world's oil is priced off Brent or a Brent blend. However, the men in the room are still relevant. But the men in the room are now the OPEC governments. And they say a number. But the number they say is not a price. The number they say is a production level, not a price. So those are the men in the room. Who's outside the room? Well, you still have the refiners operating in what I will call the wet barrel market, where real people buy real black sticky barrels of oil and sell black sticky barrels of crude oil. Okay? So they're the same. Not dominated by the majors in the way they were in the 60s, because refining is a lousy business to be in, and the majors have been desperately trying to get out of it and give all these horrible loss-making things to somebody else. However, there is a new set of players, and this is what I will call the paper barrel markets. This is the market where people exchange promises to buy or to sell, written on bits of paper. We're talking, of course, about NYMEX in New York, the ICE in London, futures markets. Now, what are the linkages between the two markets? Essentially, the linkage has to do with perceptions. So if you are in the wet barrel market and you're negotiating to buy or sell a barrel of oil, you have to write the contract. And one of the things you need to put in the contract is the price. So you start a negotiation. You have to start the negotiation from somewhere, and so you look at what the price in the paper barrel market is and you start your negotiation from there. Now, be clear what I'm saying. I'm not saying the paper barrel market sets the price of oil in the wet barrel market, but it certainly influences it very strongly. Equally, if you're operating in the paper barrel market, and the most important operators there are what I call money managers. The days of speculators are sort of, the term speculators doesn't have any meaning anymore in this context. The money managers are people managing very large portfolios of assets. These are the people looking after my pension. At least I hope they're looking after my pension. And they've got a portfolio that ranges from the very safe and secure, treasury bonds, through stocks, shares, equities, into commodities. So they look at commodities and regard it as an asset class. And they're always looking, thinking, well, what's going to happen in the wet barrel market? Is there a surplus of oil, a shortage of oil? Is the price going to go up or going to go down? I need to have a view on this so I can take a position to make money. So one influences perceptions about surplus and shortage, and the other signals what price might be. Now, what this means is price determination now is doubly complicated and uncertain. In the good old days, the men in the room said a number with a dollar sign in front, and if people believed that, that was the price. Very predictable. Today, however, the first thing is the men outside the room have to believe the production number, and secondly, assuming they believe the production number, they then have to decide how is it going to affect price. And this is where it starts to get complicated. Believing the production number is difficult. The market data on supply and demand are absolutely awful. We have no idea what world oil consumption was last year, or in 2012, or in 2011. Why? How do I know it's bad? Because it keeps getting revised. You only have to go and look at the BP stats review and compare year on year to see how the numbers change as more information comes in. So supply and demand are very poor. This is why one of the first things the International Energy Forum did when it set up its secretariat in Riyadh was to introduce something called JODI. It was then called the Joint Oil Data Initiative, to try and improve the quality of data. If you think supply and demand data are bad, the inventory stock data is 10 times worse. Okay, we really haven't got a clue. Only the OECD comes out with numbers. We know that there's a lot of stock building going on in Asia, but if anybody tells you, they probably have to kill you because it's all state secret stuff. And of course, even if the data was perfect, we know OPEC cheat. So they'll say the number in the room and then go out and do something completely different. Added to that uncertainty is then, okay, let's suppose you believe the number, how is that going to translate into a price? And here we have a serious problem. There is frequently a disconnect between perceptions in the paper barrel market and the reality in the wet barrel market. And the disconnect arises because the money managers don't understand the oil industry. They don't need to understand the oil industry. They're not in the business of doing that. All they need to do is to quote the famous phrase of John Maynard Keynes on this, is they have to anticipate what the average opinion of the average opinion is likely to be. They need to try and outguess what the market is doing. This may sound a bit strange, and it did to me. I put this view forward, and I always felt a bit embarrassed because it implied I was saying these guys are stupid, and they're not. They're very smart. They're certainly richer than I am anyway. I was giving this lecture in Oxford a couple of years ago, and one of the professors of economics said to me afterwards, "Do you done any work on foreign exchange markets?" I said, "No." And he said, "Well, what you're describing in the oil market is what we've been looking at in foreign exchange markets for years. We call it scapegoat theory. And it basically says if you're a Western-trained economist trying to predict exchange rates, and you look at the sort of metrics that a Western-trained economist would look at, it'll get you nowhere, because the guys that are setting the foreign exchange rates, the traders, are looking at a totally different set of numbers and different set of metrics. So it's not as wild as it sounds. What happens when they realize they've got it wrong is you get a rapid and dramatic adjustment. And you can see here, this is the monthly price of oil this century from 2000. It's the OPEC basket. And you can see on a number of occasions, when the money men realize they've got it wrong, they pull out the market and the price goes down. My favorite example, for reasons I'll explain, happened at the end of 2006, when they were pushing the price up and up and up. And I was going around the City of London talking to the money managers. I had one meeting with them and I said, "Why are you pushing the price up?" And they said, "Because there's a shortage of oil." I said, "How do you know there's a shortage of oil?" And they said, "Because the price is going up." And they didn't smile. This was dead true. In other words, of course there's a shortage, the price is going up. and everything we do is pushing the price up. So, that's a bit of background. Let me now turn to Opex Dilemma and explain what it is. It starts as a legacy of the Arab uprisings that kicked off in Tunisia at the beginning of 2011, which spread very rapidly to many parts of the rest of the region, Middle East and North Africa. And producer governments suddenly realized they had a major problem on their hands, and what they had to do to solve that problem was to throw money at it. And they had to throw money at it big time to try and keep people off the streets. A good example here in Saudi Arabia. The blue line shows you the number of Saudi nationals employed in the Saudi government sector, and the red line is an estimate of Saudi current expenditure, and both are rising dramatically because in the last few years, every time the king goes abroad and comes home, he invites his people to benefit from, in 2011, first it was $37 billion handout, 2 months later, $93 billion handout, which involved dramatic increases in public sector pay. That's fine and dandy. The only problem is you've got to pay for it, which means effectively the supply price has gone up. Estimates suggest that in 2008, Saudi needed $50 a barrel to be able to pacify its population. The estimate for 2012 was $94 a barrel. And you can see here estimates for some of the other OPEC countries as well. Saudi Arabia is the green bar. The weighted average for OPEC was $104 a barrel. So what? Well, they can get the higher prices and live happily ever after. But, and this is a big but, higher prices will lead to demand destruction. Meet the mix again, right? Remember the mix? 68% of the increase in oil demand is coming from there. Look at what's happened to price. Since 2002, the world oil price has been, with a bit of a hiccup here, but has been rising dramatically. That is going to kick in and affect demand, particularly now that the big consumers like India and China are passing on these higher prices to their consumers. So you're going to start seeing demand destruction. At the same time, you're going to see more supply, in particular because of the technological legacy of the shale gas revolution in the United States. The use of horizontal drilling and fracking has meant that you're seeing a dramatic increase in US production, not just in the US but elsewhere. In 2011, the joke amongst us oil analysts was that the next member of OPEC would be North Dakota. At the end of 2011, North Dakota was producing more oil than Ecuador and more oil than Qatar. Okay? In 2012, last year, US oil production increased by 1 million barrels a day. That's the biggest increase in the history of the industry in the US since it began in 1859. So, on the one hand, this illustrates the problem of OPEC's dilemma. They need a high price to survive politically, but that's going to lead to a market reaction which will need lower, weaker demand and higher supply. That is unsustainable. You only need to do Economics 101 to know you can't have a situation where if demand is going down and supply is going up, you cannot maintain high prices. And so the question then arises, are we looking at a rerun of the oil market from 1980 to 86? And that resulted, of course, in the 1986 price collapse. And again, you can see here, this was the second oil shock. This is what I call the third oil shock, because it seems to be natural justice. If you call something a shock because the consumers are hurt, if the producers are hurt, that also deserves the title of a shock. So what are the similarities between 80 to 86, 81 to 86, and now? First of all, in that period, Saudi Arabia was acting as the swing producer. What that meant was Saudi Arabia was manipulating its production to absorb the error on the data and OPEC cheating in order to get the price they wanted. The problem was, to call it a swing roll is a misuse of language, because instead of going up and down, it just went down. So in 1980, Saudi's producing 10.5 million barrels a day. By the summer of 85, it was down to 2.5 million barrels a day. And it stopped doing it. That led to the 86 price collapse. Now, in the last 12 months, it's been clear to me, although the Saudis would vehemently deny it, that they have quietly resumed that swing roll. They are manipulating their production in order to try and balance the market to get the sort of price they want. Again, 81 to 86, new oil provinces lurking to come on stream but needed a higher price. The North Sea, North Slope, Alaska, a lot of other non-OPEC countries. We have the same again today. So always press a button, something happens. We have the same again today, only now it is deep offshore and it's unconventionals, or both of which need high prices to bring them on stream. And finally, in the early 80s, very bullish outlook on oil demand, which ignored price effects. I already talked about that. We have the same thing again today. The forecasters are making the similar sort of error that was made in the 80s. There are, however, some differences. Price determination now, as I've tried to explain, is much more complicated than it was then. Then, men in the room said a number, fine, that was the price. Now it's much more difficult. Then there were no papers or futures markets. Small gas oil futures market in Chicago, the beginnings of a paper forward market in North Sea oil, but unregulated. Now, of course, you have all singing, all dancing futures markets, and that means that prices can move and change much more quickly. Prices are going to be much more volatile. Also, then the idea that there would be revolution in the streets in the Middle East was virtually unthinkable, despite the Iranian Revolution. Now there's much greater threat of political unrest. If you get that, that is going to spook the markets. So if the price does go down a la 86, and the governments can't get the revenues, and you're going to get riots in the streets, the price is going to shoot back up again. Also, you now have much greater divisions within OPEC. OPEC has always had problems, always been divided, but since 2003, and the American intervention in Iraq, you now have a much clearer division between Sunni and Shia in OPEC in a way that you never had in the past. So what conclusions on future prices? Well, I think a lower price is very likely, a much lower price. Unfortunately, I don't know what the timing is. If I did, I could make a great deal of money out of it. The reason I don't know what the timing is because I don't know how long Saudi Arabia is willing and able to play the swing role. How much wriggle room do they have? How much financial cushion do they have that if they do need to start bringing down their production, they can still meet their budgetary requirements? When the price falls, as I say, political unrest in MENA is likely to lead to a price rebound driven by the money managers. And of course, lurking in the background all the time in this situation is the potential for more geopolitical outages. Don't forget, this year, we've lost 1 million barrels a day from Libya, 800,000 barrels a day from Nigeria, 300,000 barrels a day from Iran, 300,000 barrels a day from Iraq. That is quite a lot of loss. Now, why haven't we noticed much impact on price? Because Saudi Arabia has turned the taps up. And while they're turning the taps up, that's okay. But as these things come back on, and there are no more geopolitical outages, then Saudi has to reduce its production. Right. The last couple of slides, and this is where I'm treading on very dangerous ground indeed. Okay, so I ask your indulgence. What are the implications of oil price volatility for a country like New Zealand? Well, let's have a little look at the energy picture here, which I'm sure you're all familiar with. That shows you New Zealand energy consumption from 65 to 2012. And as you can see, oil is a pretty important part of the story. In 2012, it accounts for about 35.5% of primary energy consumption. And this is an important point, the vast majority of that in New Zealand is in the transport sector. The significance of that, of course, is that you have limited alternatives. If you're using oil to generate power, or there's other things you can use, but if it's in the transport sector, then unless you're going to start doing interesting things with electric vehicles, or CNG or other things, then you're stuck with that. Also as well, it's worth pointing out you have a very large other energy consumption in New Zealand. And that, of course, is largely hydro, a little bit of wind, and other geothermal and biomass. In other words, essentially renewable energies. So, what about the economic picture? That is a picture of New Zealand's balance of trade. As you can see, the start of the century in surplus, in the middle of the century goes into deficit, and then towards the last few years it's gone back into surplus again. So what? Well, let's look at the net oil trade. That's the net petroleum imports for New Zealand. In other words, it's significant in terms of your potential balance of payments. Now, what's this got to do with volatility? Well, if you're going to have oil price volatility, those blue bars are going to look like yo-yos as they're going up and down. It's going to be very difficult to have a sensible macroeconomic strategy in that sort of a world. There's also the problem that if you have volatile prices, then this inhibits investment. Investors don't like volatile oil prices. You are interested in trying to develop, right, for good or evil, depending on which side of the fence you're on, oil and gas resources in New Zealand. If you're serious about that, and you're trying to get people to come in and explore, you're going to have to remember that in a volatile price world, a lot of investors are going to be very, very uncertain about investing. And in particular, you're going to be competing for upstream dollars with a lot of other potential areas for investment, which means that if you are serious about trying to develop the resources, you're going to need a fairly attractive fiscal regime in order to attract those upstream investment dollars competing with other people. I'm thinking, for example, if Iran manages to come to some sensible deal with the United States, the oil companies will be like flies around a honeypot in that particular one. And there's lots of other areas of the world as well that are open. There's another point as well, and that is New Zealand, and I go back to the point about the advantage of you do a lot of renewables, which means you have a lot of renewable technology, which you are in a position to then sell abroad and earn export earnings on it. The problem is, in a volatile oil price world, which also, by the way, means a volatile gas price world, then there are question marks about people's willingness to invest in renewables, and this could again threaten it. On that cheerful little note, I will stop. Thank you very much indeed for your attention. I hope you got something out of it. I'll be very happy to take Q&A.